Well, the media and social media has put people in a frenzy once again, especially people thinking about buying a home and getting a mortgage. The word on the street is people with great credit have worked all their lives and building great credit and being responsible with their money are going to get penalized or punished for that when seeking out a home mortgage, and the people with less stellar credit will be paying less. Is that true? Is that a lie? Well, today we're going to bring on mortgage lender Michael Campatese of Proper Rate, and we're going to find out what's true and what's just a downright lie so we can get rid of it and move forward and put our home buyer clients at ease. So let's get started. Hey, well, Mike, how are you today?
Good. How are you, Slav?
Fantastic. Thanks for joining me today.
Good.
This is very timely, I think. As of May 1st, the new fees, the LLPA, and I'd like you to talk more about what that is um, and how it affects home buyers and the mortgages they're going to get. The word out there is that people with better credit scores are going to be paying more for their mortgage than people with less than stellar credit. To me, that doesn't make sense. However, that is some narrative that some people are buying into. So why don't you take it away and kind of explain what is going on, what these fees are? Is this something new? Is this something that's been around for a while? And what it really means to the home buyer today.
Yeah, thanks, Slav. I think this is kind of a classic case of what you're seeing out there, specifically with the media, is just spun in a way to kind of stoke some fear. And our job, in the real estate world, is to educate our clients and everyone out there that what is actually true. Okay, so the LLPAs, which stands for loan level price adjustments. They were announced to us as a lender back in January from Fannie and Freddie. And we've been slowly figuring out a way to have them worked in. And now it's basically hit the mainstream, and all banks now have figured out a way to basically bake these into the rates, which is ultimately what it ended up happening. Okay. So the loan level price adjustments, and the reason why it basically came about is that it went to kind of cater to a traditionally underserved market. Okay. So, and it wanted to level the playing field of all lenders. Okay. But what the reality is that if you have good credit, you are still going to get, at the end of the day, a better interest rate than somebody with not so great credit. So what I've done is put together kind of a basic scenario for, if you want to pull that up, we can kind of go through the actual scenario. So what you'll see here is a $550,000 purchase price. Okay, so a $550,000 priced home on a 30-year fixed mortgage. You have three different scenarios there. You have somebody with a 680 credit score, somebody with a 720 credit score, and then someone with a 780 credit score. And then I've broken it down in 5% down payment and 20% down payment. And what you'll see there is, and these are rates as of today. So if you have a 680 credit score, a 30-year fixed interest rate with 5% down is 6.99% versus somebody with a 720 credit score, 6.875%. So not a huge difference there, really only, about $41 a month and an eighth of a point in interest rate. Okay. And then the 780 credit score, you'll notice, is a sizable difference, almost a half a point difference between a 720 and a 780. So that has been the biggest difference that we're seeing with these loan level price adjustments, is that the new perfect credit score is a 780. It used to be a 740, and now what we consider to be perfect is a 780. So that 680 credit score and the 780 credit score, there is a $200+ difference and a half a point in interest rate. So the narrative that you're seeing out there is that if you have a bad credit score or less than perfect credit score, you're going to get a better deal than someone with a higher credit score. And that's just simply not true. Okay. And then you'll notice with the 20% down, and here's what I think is the biggest kind of change, is that you'll notice in that 680 credit score scenario, if someone puts 5% down, they're getting 6.99%. If they're putting 20% down, they're getting a higher interest rate, okay? So the reason for that is that with the 5% down scenario, there's mortgage insurance or PMI. So the banks are basically incentivizing you to put a little bit less money down to give you a little bit of mortgage insurance per month, which at the end of the day is not the worst case scenario because mortgage insurance rates are also at all-time lows. And that might give your client the ability to maybe keep a little bit more cash on hand, not put as much money down, get a better interest rate, maybe save some of that money for future investments, or maybe the house that they're buying needs some work. So, that's a really good advantage, is maybe just not putting as much money down. So if you walk away from this with anything, it's really that good credit still remains supreme. Everybody should still do everything they can to make sure that their credit is as good as it possibly can be. Pay your bills on time. Don't let credit cards get maxed out. Keep those balances at 33% or less of the available credit limit is ideal. So what we're basically seeing is that the narrative out there is just not as true as what the reality is.
So that let me get this straight. So I shouldn't go out and max out my credit this weekend and not pay my bills?
No, I would advise against that, Slav.
Sure. All right. Well, you know what? People do get caught up in a frenzy, right? You hear a lot of things going out there, and by now we all know that everything you hear on Facebook, Twitter, YouTube, and Instagram, it's all true, and it's easy to get caught up. But it's important to take a step back and think of it in this scenario. If you're loaning money to somebody, right, who do you feel more comfortable loaning money to? Somebody that has been responsible with their money, or somebody who has been less responsible? Doesn't mean that you're not going to loan somebody that's been a little less responsible. However, there's a risk in it, and that's why they're paying a little more on the interest rate, isn't it?
Yeah, and that's why I feel like people like you and I are so much more important now in the transaction, because we're the experts. So talking to somebody in real estate that knows what they're doing, reaching out to them, running the numbers, making sure that it actually makes sense. Because really, at the end of the day, the most important thing for a buyer is that the monthly payment works for them. That's what we talk about all the time, is the payment. The rates are going to go up, they're going to go down, they're going to do what they're going to do. But the payment is the most important thing. And if it works for you and it works within your monthly budget, then now is a great time to buy.
Yeah, great. And I love the scenario you have there with someone with less than 720 credit score. The perception out there with a lot of buyers that I work with, especially first-time home buyers, is that you should be putting 20% down. However, as you're showing in this graph, somebody with a 680, they're actually going to have they're better off, maybe saving some money, putting aside, and having a lower interest rate, right?
Yep, absolutely. Yeah. It's not a huge difference in interest rate, right, but it could be a big difference for them from a cash flow perspective.
Exactly.
What's happening a lot of times now is that some of these older homes need a little bit of work.
Yep. Great information. So I got a question for you. The Fed recently announced that they're raising their rates again. Now, this doesn't necessarily mean that home mortgage rates will go up as well, does it?
No. And in fact, the last time the Fed raised rates a quarter of a point, long-term rates, meaning a 30-year fixed mortgage rate, actually went down. So basically what the Fed does is when they raise interest rates, what they're referring to is short-term rates, what banks borrow from other banks overnight, okay? What is immediately impacted by the Fed raising rates is if you have a home equity line of credit, for example, that's based on the prime rate, that will be immediately impacted. So the prime rate right now is at 8.25% with the recent Fed increase of a quarter of a point. So if you have a home equity line of credit, your monthly payment just went up slightly, okay? And just one thing to note about the Fed is this recent hike is the 10th hike they've made since March.
Right.
And they're noting that this is the last hike that they see for a while until July, where we might actually see some rate cuts. So they're getting a good sense that inflation is kind of staving off, and hopefully this is the last hike we'll see for a while. But the 30-year fixed mortgage, as of this morning, the rates haven't changed since yesterday. So we're hoping that's already baked in, and the rates won't go up anymore for a little while.
Yeah, great. And I know that's a relief and good news for home buyers out there, especially hearing that this could be the last hike that they're planning, right?
Mm-hmm.
Yeah. So, Mike, great information here. And this one more thing I want to talk about, going back to the LLPA. I pulled up an article in Inman, and Inman's a great resource for real estate news. And going back to who these fees affect, and this says, I'm going to read this verbatim. The fees don't apply to first-time home buyers with qualifying income that's less than or equal to 100% of the area median income, or AMI, in their markets, or 120% of the AMI in high-cost markets. Now, that is even making my head spin. Can you put any sense into what they're saying right here, and how that affects first-time home buyers?
Yeah, that's a good question. So several years ago, they created these what they call census tracts, and within those census tracts, they're the only true way to measure the area is by area median income. Okay, so that is a way for the banks and essentially Fannie and Freddie to try to level the playing field. And it goes back to what I was mentioning earlier. This is basically to just try to cater to an traditionally underserved market when it comes to housing. So basically what it is if you have income, and we have calculators that we use, that if your income, depending upon your zip code, is under a certain amount, you are not affected by any of the changes that have been made. And in fact, for you from an interest rate perspective, if you live in those areas, you might get a better interest rate than somebody that lives in another area, simply because the area median income in that area is lower than the average. So that's what that basically refers to. And the LLPAs and all these recent changes that have been made don't affect those areas.
Great information. And one thing we talked about before, it's very important for realtors like myself not to quote interest rates for home buyers, because as you're showing here, there's a lot that's involved in determining what interest rate and what monthly payment each set of buyers will be experiencing. And that's why they should contact somebody like you to get, really, like you said before, that monthly payment. What is it going to be based on, what you're making, your debt to income ratio, and your credit score, correct?
100% true. The interest rates are so much more tiered now than they ever have been. So I'm urging all real estate professionals to try and not quote interest rates, because you don't want to be put in a situation where you're quoting a rate that's just not accurate. Somebody might say to you, listen, Slav, my credit's perfect. I have a 720. I'm going to get the best interest rate. Oh, okay. Well, then, you're going to quote the rate of the day. When in fact, the credit score of a 720, as you're seeing here with that scenario I just said, is not as good as a 780, which that interest rate is 40 basis points higher with a 720 credit score than it is with a 780. So I think it's just safe to say, talk to your lender, because there's been a lot of changes lately, and based on your credit score, your interest rate will vary.
Yeah, fantastic. So, Mike, how can people best contact you to get more information on what fees apply to them, what don't apply, and what their interest rate would be based on their situation?
Yeah, as always, my cell phone is the best way to reach me, 773-220-8859, and my email, mgambatis@properrate.com. That's my first initial and my last name at properrate.com.
Yep, and I just put that up on the screen, so take a screenshot of that and be sure to call Mike with all your mortgage needs and questions. So, Mike, thanks again. I appreciate it. A lot of great information here, especially I think we kind of dispelled some myths or lies. And the ugly truth is, lies, especially when they're dramatic, as what's been going on, get spread very quickly and need to be squashed as soon as possible. So I appreciate you using your expertise today and letting us know what is true and what is a downright lie, so that home buyers today can move forward with peace of mind. So appreciate it. You have a fantastic day. And this is Slav Polinski, Slav Polinski Homes. Make it a great day.